In 2007 and 2011, Daddy Bezos paid $0 in federal income tax. In 2018, Elon paid the same. Even the Oracle of Omaha admits that he typically pays a lower tax rate than his secretary. Welcome to America. Billionaires are out here launching rockets, buying social media companies, and aging backwards, and somehow you're the one keeping the country afloat with your relatively pathetic income. The craziest part is, they're not even breaking the law. In fact, they follow it to the T. They follow it the way Sam follows Frodo, the way Joe Goldberg follows girls, the way Diddy follows 14-year-olds. In this video, we're diving into the legal tax loopholes billionaires use to reduce or outright erase their tax bill. Are you going to be able to use any of these to reduce your own tax bill? Probably not. You're still a level 1 peasant. But if the day ever comes where you've scammed enough noobs with your e-commerce or day trading course and finally find yourself with a little cash to protect, then you'll be thanking God you watched this video. Let's go. Before we dive into how billionaires legally scam the entire country, you need to quickly understand what taxes exist in the first place, otherwise you'd have literally no idea what they're trying to dodge. First, we've got income tax. This one everyone knows. You work a job, you get paid, the government reaches into your paycheck and takes 30%. Billionaires avoid this one by not having an income. Wild. Then we've got capital gains tax. This is the tax you pay when you sell something that went up in value, like stocks, real estate, or crypto. Capital gains get further broken down into short-term and long-term gains. Short-term is for gains made in less than a year, and they get taxed like regular income. Long-term gains are gains made over a year and get taxed at a lower rate. Third, we've got estate tax. This is the tax your heirs pay when you die and leave them a bunch of assets. If your estate is big enough, the government shows up at your funeral like, sorry, but we're going to need 40% of this. Fourth, we have corporate tax. Taxes paid by businesses on their profits. There's also a bunch of other taxes. Property tax, sales tax, payroll tax, and whatever else. But these are small enough for billionaires not to care too much about, so we're mainly focused on the big four. Alrighty, let's dive into the strategies billionaires use to evade taxes like Neo avoids bullets. Here's how it works. Instead of selling their stocks or assets, which would trigger a capital gains tax, billionaires just borrow against them. They walk into a private bank, hand over a balance sheet that says, I own 30 billion in stock, and the bank's like, cool, here's 500 million cash. No taxes, no selling of assets, no public disclosures, just a fat loan they'll probably never repay. Let's talk numbers so you really get why it works. I identify as a billionaire, which makes it so.
I'm also a transplant. That's why I identify as a tree.
Say I want 10 million cash. I could sell 10 mil worth of stock. This would then trigger a number of tax debts I'd have to pay. Let's say it's at the long-term tax rate. We've got 20% federal tax, maybe 3.8% net investment tax, and even a state tax if I'm dumb enough to still be living in California. That's roughly 25 to 30% gone. So I sold 10 mil worth of stock and walk away with 7 mil cash. Kinda gay. What if I borrowed the 10 mil against my billions in assets? Well, I'd obviously have to pay interest, and on rich people loans, the interest rates are usually pretty low, maybe around 2 to 4% annually. So I'm paying somewhere in the ballpark of 200 to 400k a year in interest, which, by the way, is often tax deductible. And remember, the underlying assets are still growing. The stock, which you didn't sell, is going up in value, and you still own 100% of it. So all in all, the cost of borrowing is actually far less than the cost of selling. This is often referred to as the buy, borrow, die strategy. You buy the asset, you borrow against the asset, you die and pass it on tax-free thanks to stepped up basis. What's that, you ask? Let's say you bought 10 mil worth of stock and held it until it was worth 100 mil. If you sell it, you're paying capital gains tax on the 90 mil in profit. But if you die and your kids inherit it, they get a new cost basis of $100 million, the market value at the time of your death. Which means if they sell it immediately, they pay zero tax. So here's how the strategy works. You donate assets to a private foundation or a donor-advised fund, and when I say donate, what I actually mean is you transfer money or stock into a thing you technically don't own anymore, but you still control exactly how it gets used. And then you get a massive tax deduction. Congrats, you're now a
genius, billionaire, playboy, philanthropist.
Let's break it down. Let's say you own 50 mil in stock that's gone up in value. If you sell, you pay capital gains tax. You know the drill. But if you donate the stock to a foundation, you get a charitable deduction for the full market value of the stock. And you avoid paying capital gains tax on the appreciation. So imagine your income was $60 million that year. You've now reduced your income down to only 10. At 60 mil, assuming a 37% federal tax rate and no state tax, you're paying around 22 mil in tax. After the donation, you give away 50 mil, your income is only 10 and you pay 3.7 mil in tax. And you also save on any capital gains involved in the 50 mil you donated. So here's the two main flavors of this play. One, private foundations. You create your own mini charity, put your name on it, think Chan Zuckerberg Initiative, Bill and Melinda Gates Foundation, and then you decide where the money goes, who it helps, and how it slowly gets deployed. The second is through donor-advised funds. You don't start your own foundation, you just park your money in someone else's. It's like opening up a savings account at a charity bank. You get the same tax benefits and you advise where the money goes later. Advise meaning you basically just tell them. So in summary, you donate assets you don't want to pay tax on, you get a massive tax write-off, you still control how the money is used, you get applauded in the press for your generosity, and your family and friends all get jobs running the foundation, legally paying themselves salaries. You don't pay Uncle Sam, you give to a cause you care about, you employ your loved ones, and you get clout from the media. Win, 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 win. So the IRS says that real estate depreciates over time. It gets worn down, aged, weaker. But instead of just having to deal with it, you get to write the depreciation off on your taxes. For residential property, the IRS lets you deduct the cost of the building, but not the land, over 27.5 years. For commercial property, it's 39. Let's say you bought a $10 million apartment complex. The land is worth 2 mil and the building is worth 8. Divide that 8 mil by 27.5 years and you're looking at around $290,000 per year in depreciation deductions. That's $290K that you get to subtract from your taxable income every single year, just because your building exists and is getting a little older. The other cheeky thing you get to do is cost segregation, which is where you pay an engineer to walk around your property and say, yeah, that carpet's going to die in 5 years. That light fixture, 7 years max. That toilet, basically dead already. And so now, instead of depreciating the whole building over 27.5 years, you get to accelerate a bunch of it into just 5, 7, or 15 years. Why would you want to do that? Well, would you rather more money now or more money in 25 years? Exactly. Money today is worth more than money tomorrow. So overall, you buy property, you say its value is degrading by 1/27th of its purchase price every single year, you shred your taxable income with the write-off, and you've got an asset that's increasing in value. What the hell else could you want? So this one's pretty basic and probably something you've heard of before. You're basically just exploiting the fact that the capital gains tax rate is far lower than the income tax rate. And so you'll find a bunch of billionaires, mostly in tech, taking tiny salaries, like $1 a year. Not because they're humble or because they don't care about money, it's because their salaries get taxed like shit. So instead, they get paid in stock options, which gives them the right to buy shares of their company at a set price in the future. Let's say Zucks gets 100 million stock options. When he sells those shares, if he's held them over a year, he pays 20% capital gains tax instead of 37% income tax. So instead of paying 37 million taxes, he's only paying 20. Literally saved himself $17 million just by being comped stock options instead of cash. Or better yet, he never sells the shares and just uses loophole 1 to cash himself up. This one's about losing money. Kinda on purpose. Welcome to the weird world where billionaires use their losses strategically so they can pay less tax on their wins. Here's how it works. If you have investments that went up and you sell them, you owe capital gains tax. But if you have other investments that went down and you sell those too, you can use those losses to offset the gains. Let's say you bought a bunch of Nvidia stock for 100K. Then it drops to 60. Ouch. You now have two choices. 1, do nothing, hold, cry a little and hope it goes back up. Or 2, sell it, realize the 40K loss, and use that loss to offset gains elsewhere. So if you've got another investment that made 40K profit, selling this loser lets you cancel out the tax you would have paid on that gain. So you've effectively turned your loss into a tax shield. Now you might be wondering, why would you ever harvest a loss? Wouldn't it be better to never lose? Yes, of course, the ideal is to never lose, but unless you're Jim Simons, investing comes with losses. And so tax loss harvesting isn't about intentionally losing, it's about what you do once you've already lost. And what if you actually really believe in Nvidia and you just know it's going to go back up? No worries. Still sell the loser, which locks in the tax benefit, then wait 31 days, which gets the IRS off your ass, and you can then buy the stock again. So now you're back in the position you wanted, plus you got a shiny tax deduction. So in short, you don't harvest losses because you want to lose, you harvest losses because you're inevitably going to lose sometimes. And when you do, you might as well use it to reduce taxes on your wins. This is the reason we've all heard about the Cayman Islands. So the basic strat, set up companies in low tax countries. Then use clever accounting to move your profits there, even if the business actually occurred in the US, UK, or wherever else. Here's an example to really illustrate. You're the founder of Diddy Oil USA, a US-based startup that sells body oil. But instead of making Diddy Oil USA pay all its taxes in the US, you set up Diddy Oil Ireland and Diddy Oil IP in the Caymans. Then you say, actually, Diddy Oil Ireland owns the recipe and branding for the oil, the intellectual property. And so every time Diddy Oil USA sells Diddy Oil in the US, it has to pay huge fees to the Ireland company for using their IP. And this expense crushes your US profits. Diddy Oil USA looks broke, but Diddy Oil Ireland, balling, because it's collecting those fees untaxed or very lightly taxed in Ireland. And then Ireland can funnel the cash down to Diddy Oil IP in the Caymans where the tax rate is 0. No corporate tax, no income tax, no capital gains tax. So now you can park your cash there, untaxed, and do whatever you want with it. Except bring it back to the US. But you could do things like buy Bitcoin, invest in foreign ventures, loan it to other businesses you control, or even loan it back to Diddy Oil USA. Why does this work? Because the US tax law says if your profits don't come back to the US, we won't tax them. Right away at least. So companies will leave their profits chilling offshore for years, sometimes forever. But wait, didn't they close these loopholes? Yes and no. In 2017, the US passed the Tax Cuts and Jobs Act, which basically tried to stop companies from stashing income in tax havens. But spoiler alert, rich people have good lawyers, so they just restructured the loopholes. They didn't stop using them. So yeah, that's how the richest people in America legally avoid paying for the country. They use the country's infrastructure and courts and consumers, and then they pay almost nothing for it. Did you really expect the greedy fuckers to be any different? Please remember to like, comment, and subscribe, and I'll see you in the next one.